Good evening, lecture, and good evening, everyone. We are from Group 2, and for today, we will be present Chapter 1, Emerging Risk to the Recovery. Next slide, please. Okay, so here's move on to our content. First of all, we are going through a brief on the introduction, and second, we'll be moving to interconnected financial risk across the economy. Third, we will talk about from health crisis to financial distress, emerging risk to the recovery, and fourth, we are going to talk about the global economy. Fifth will be conclusion, and the last one we will be go a little bit into Spotlight 1.1, in which it focus on financial inclusion and financial resilience. So in my group we have me, Kadane, Sasukun Kanita, Sonita, Yum Vanessa, and Bong Radavin. Next slide, please. Let me go briefly a little bit about the introduction. So far as we know that the COVID-19 pandemic has sent a very large shock wave toward the world economy, and that raised concern on a high level of private and public sector that however, according to the book, even with the effectiveness of the government response that already have to stabilizing output and protect the income, still there is some pre-existing financial risk to household and firm financial sector, and also the same as public sector balance sheet that may pose a threat to an equitable recovery in a very long term. So moving on to the question, so why is it important to address the economic risk? So according to the book and response, by addressing the economic risk, it is not only help to ensure a return to economic growth, but it also counteract the impact emerged by the COVID-19 crisis. For instance, poverty issue, inequality issue, and so on. Further, it is also one. So 1.1 conceptual framework, interconnected balance sheet and risk. It showed that the link between the main sector of economy through weak risk in one sector can affect the wider economy, since it has interconnected with one another. And as for the last chapter, we call it as for the previous chapter in the present by the group 1, it's called its spillover effect. And as for this chapter, it outlines a conceptual framework of interconnected balance sheet, risk that authoring and compassion view of interrelated financial risks that will shape the economic recovery. And further, the framework also recognized the important role of pre-existing fragility and global economy factor in the recovery prospect of emerging economy, and they also highlight out the complementary that exists between policy that focus on addressing the financial risks that have accumulated across the economy. Next slide, please. That is all.
So thank you, Danae. So this part we will look into the spillover effect. So as you can see in the slide, we talk about the economic links and the spillover risk. So in this section, we look into the link between actors in the economy and how the connection creates spillover risk. So the financial health of household is connected to larger economy through what is called the household sector nexus and the household government nexus. As you see in the first circle on the left-hand side, when household financial health is deteriorated, it affects the financial sector as a result of loan default and loan provision requirement. Thus, this lead to the worst condition of financial health sector that will lead to the supply of credit lesser and lesser with a higher interest rate from the bank. This will eventually depress the economy, and the circle will go into the vicious circle. And the second one, talk about the household and the government nexus. So you can see the second circle demonstrates the connection between household and government because government has the ability to support household directly in time of need or desperate. They also rely on household like in the form of tax collection from the household. But when household revenue decline due to the COVID-19 and disruption, which it will depend on the government budget that will lead to the lack of support and support to the household, and the circle will repeat. Please move to the second slide. Thank you. So similarly, corporate health is also connected to the wider economy like the previous two nexus. So in this nexus, corporate financial health affects banks when they are in distress of financial because of the insolvency and loan default. So this in turn affects the financial sector balance sheet, which force them to extend less credit and charge more for who come to borrow from the bank. So in this lecture, there are three loops that make the connection more stronger and stronger, which reinforce the connection. So in terms of the deterioration, first, because of the bank keep channeling credit to firms that are, let's say, de facto insolvent and keep delaying non-performing loan. So this called in about they call this a zombie lending because the bank keep misallocate the credit to unproductive firms that reduce the financing to profitable firm. And the second, uh, the reinforcing is the distinguishing problems that occur when the bank contact the difference between which firm are insolvent or has liquidity problems. So the bank may lend to both type of firms, which eventually depress the economy and more in this case. So please move to the third slide. Thank you. So the another link is called the next corporate and government nexus. So in this nexus, government spending like support corporate directly through public procurement, and in directly they transfer a guarantee like infrastructure investment and support scheme, something like that to the corporate. So tax policy is also used to stimulate economic activities, and they use the policy to set incentive for efficient allocation of resource or cooperation during the depression. So when the corporate finance is good, it affects a government in terms of tax collection from them. So they can collect more. But in this case, when they face economic downturn, like during the COVID, the corporate doesn't have enough of finance, so it will affect the government ability to collect tax from the corporate too. In the sense, please move to another slide. So another link they call government financial sector nexus. So in this nexus, the most stake like financial sector connected with financial health of the government. First, in the direct channel, as you can see, financial institutions hold government securities, and when the government like face tough financial position because of COVID, it also affects bank balance sheet. So in turn, when banks are weakened, government bond is less purchased by those bank because bank usually the one who buy government bond. This will cause causing like the purchase by the financial institution. In this case, it means that the because of the deterioration in the financial health, it will reinforce negative feedback, like causing distress in the economy. And the second one, like you can see the government bailout, I support the biggest. It means that government and central bank, they have agreement in place, like they were assisting liquidity in time of crisis to support a financial institution when there are depression. So government like cannot extend from bailing out big banks. So especially like the important one, like they call it that the bank that is too big that cannot be failed. So they had to bail them out to avoid any financial like burden in the economy. Please move to the next slide. So another nexus, like the is called the indirect channel. Like the first one that you can see that the connection that I suppose like first like fiscal and real sector, they are interconnected with one another. So when the government financial position weaken, like fiscal consideration will be introduced. So this means that this will weaken the economy. And second, uh, banking and real sector, banking and real sector also are interconnected with one another. So real sector need access to credit for the production of goods and service. And when banks are in distress, production is also reduced. So when the business are worsened, government can be exposed to a credit loss because of they support in finance to sector, important sector in the economy. So please move to the next slide. So like with all these economic links that I just presented, so what policy have been enacted to prevent crisis during this COVID? Like in this left-hand side, you can see that like many countries in the world, they use a common two macro economic policy like fiscal and monetary policy in order to mitigate the effect of COVID-19. So the fiscal policy is mainly used to support the balance sheet of household and businesses, like in order to prevent our aware of loan default and the spillover of the economic shock to the financial sector. Another policy that is used is a monetary policy, like the central bank used to strengthen the resilience of financial sector, like to ensure that the well capitalized bank or the big bank were in a position to continue to supply credit to lenders. No, to household and firms. So, however, like even though the two common policy are used, there are some government are already in that, like developing country. They need more money, so they borrow from outside to supply their economy during the crisis. And because of that, they have the inability to collect tax revenue during economic downturn, causing them to not be able to finance all these two macro policy effectively. So it's called two pitfall. The first one, let's say that states, developing countries specifically, they have capacity constraint that prevent them to enact such a support comprehensive policy to nationwide. And the second, like the comprehensive policy to support structural actors in the economy, increase the level of borrowing from foreign government, because when they want to stop the like to mitigate the crisis, they need to borrow more. So in this paper, it will increase more government debt or public debt in this field. So this is all from my presentation. Let's move to the next presenter. Thank you.
Okay, so now we're going to be talking about the no previous slide. Okay, so now we're going to be talking about the health crisis to financial distress, about the emerging risks to the recovery. So the initiatives implemented to address the COVID-19 crisis has strengthened the economic ties between households and businesses, the financial sectors, and the government. If the flaws aren't addressed quickly, it could pose a threat in the long-term strong and fair recovery. Many of the policies implemented during the COVID-19 crisis are are novel, such like the central bank assets purchase programs in emerging economies, which has never been used at the scale of such as debt and moradia and regulatory forbearance, or the potential to create various long-term risks to the recovery, such like hidden debts and contingent liabilities, which may become apparent later on. Next slide, please. Okay, so this leads to the question, to what extent did the pandemic affect households and firms? Because households still find it difficult despite the extensive fiscal support measures taken by governments worldwide, as a pandemic has led to a significant tightening of balance sheet. Even with the government adopting cash transfer and income support programs to assist households and prevent banking sectors spillover, many of the programs were insufficient to compensate for a magnitude of income losses. The majority of households, both developing and advanced economies, do not have enough liquid assets to sustain basic consumption for more than 3 months, and most governments lack fiscal resources to maintain income support programs for a sustainable amount of time. So as a result, before households' earning had recovered, several income support programs had to be phased out. This applied especially to countries that suffered multiple waves of pandemic, lacked strong automatic stabilizers such as unemployment insurance and other social safety nets, and were unable to mobilize external fiscal resources for prolonged support measures. And these factors increase households' vulnerability as well as potential spillovers to financial institution when non-performing loans rise. Household incomes were particularly hard hit in countries with limited social safety nets and a large share of employment in the informal sector. This was because of the aggregate nature of the shock informal insurance mechanism that could have mitigated the impact of the economic shock, such as borrowing from family friends, which is and was ineffective. Transfer payments could not compensate for the sharp decline in incomes and were insufficient substitute for informal insurance mechanism in emerging economies. Further, this access to various support schemes varied considerably among population categories and did not reach households working in the informal sector without access to a formal financial account, who were among the most badly impacted by the crisis. In the long run, this unequal access to assistance services is likely to worsen poverty and inequality, which as well as impair household resilience. So many governments coupled income support measures with far-reaching debt forbearance programs to avoid an early increase in consumer debt defaults and spillovers to the banking sector. A freeze on credit reporting was included in many of these debt relief schemes. Such policies create a difficult trade-off. On one hand, it was beneficial in the event of a temporary shock, as it lessens the likelihood of borrowers being forced to default on their loans or lose access to credit due to temporary liquidity issues. However, if such forbearance rules are lifted too soon, it will trigger defaults among otherwise creditworthy borrowers whose incomes has not yet recovered. They can be insufficient in preventing financial sector spillover. So on the other hand, if debt relief policies are in effect of an extended period of time, it can obscure the true size of non-performing loans and hide credit concerns that emerge once debt moradia are withdrawn. So similarly, a variety of policies have been implemented to offer liquidity to corporate sector in the hopes that the public health crisis, like the financial difficulty of businesses will be temporary. Direct grants and transfer payments, tax benefits, as well as credit subsidies and guarantees have all been part of these policies. So although providing direct assistance to businesses is a good idea in the short term to prevent viable businesses from going bankrupt and losing jobs, it's critical that support policies are crafted in a manner that do not distort the allocation of resources in the long run. The financial status of households and businesses will be affected by government and financial sector feedback effect. So governments that entered the crisis with high debt and insufficient fiscal resources to respond to the crisis, or had to prematurely phase down support programs. With severe fiscal constraints, government would be unable to protect households and firms from unfavorable events during the recovery. External economic shocks, example such as a possibility for low and middle income nations whose recovery is heavily reliant on international environment. There are many sustainable businesses relying on a steady supply of credit, which could be threatened if the financial sector is stressed by external shock, government risks, or an increase in loan defaults when government assistance programs are phased out. So government's arrears can expose households and businesses to tightening public sector balance sheets. Of many governments, particularly those in low-income nations, have resorted to suspending or delaying payments for goods, services, and work procured from private sectors as a result of the crisis. Some governments have either halted or postponed paying public sector employees. It is economically costly to finance relief and recovery initiatives as accumulating arrears, since it directly counteracts stimulus efforts by denying people of income and limiting firms revenue at a time when liquidity is critical for survival. Government arrears are the prime example of an economic relationship between the public and private sectors that has been aggravated by the crisis, has an asymmetrical larger negative impact on small and informal businesses, and constitutes a serious threat to recovery. So my friend will be covering the other part of the point. Thank you.
So first of all, I would like to apologize for the traffic noise I'm stuck in heavy traffic. So the um, this is the financial sector. So the pandemic traditional financial sector crisis of the deterioration of asset quality. So gradual deterioration of asset quality in the aftermath of the pandemic, in which it could lead to a longer term outcome that looking very similar to that of the traditional financial sector crisis. And the financial institution grants of the grace periods and moratoria for the loan repayments, in which it's mandated by the government and regulators. The financial institutions have granted grace period and moratoria for the loan repayment on an unprecedented scale, in which this policy can play a significant role in order to stop the default among the credit-worthy borrower that they suffer from the temporary issues. And the excessive periods of the policy, it can lead to the credit market distortions. So, however, if it left in the place too long of this policy, it can lead to the credit market distortion and make it difficult for banks to distinguish between the credit-worthy and the non-credit worthy borrowers, and it can reduce the new lendings. And to next slide. So in here's the debt moratorium enactment of the COVID-19 crisis, which accompanied by a freeze of credit reporting. Some debt moratorium enacted in response to the COVID-19 crisis that was accompanied by a freeze on credit reporting, so long as the forbearance program are in place, banks can have opportunity to distinguish from the insolvent borrower, and this can make them more reluctant to issue new credit. And non-bank financial institutions account for a high share of private credit in uh, in many emerging markets. The institution of the non-bank finance, which account for the high share of the private credit, they are typically less regulated than the banks and may accumulate credit risks that are less apparent. And balance sheets of non-bank lenders come under stress, leading to far-reaching repercussions for the real economy. When the balance sheets of the non-bank lenders come under stress, there are far-reaching for the real economy, and the lenders of the non-bank ability to supply credit is can affected directly from the exchange rate and the international interest rate environment also. And assets quality in the financial sector deteriorate as the government fiscal position worsens. And uh, in many governments have financed their COVID response by issuing new debt that is caused by the domestic and domestic financial institution. And as the government fiscal position worsen, the quality of the asset in the financial sector can deteriorate. And next slide. So in here's the government, the challenges created by the pandemics, it can go beyond the household and firms balance sheets in the emerging economy, in which in the emerging the challenges created by the pandemic can go further than the household and firm balance sheet. The large fiscal support program can enact in the response to the crisis, that it can lead to the dramatic increase in government debt. And in 2020, five government on their obligation to external private creditor, and the onset of the pandemic can brought about a dramatic reversal seen GDP and tax revenue collapse, and the limited fiscal resource. It can may require many of the government to pays out in order to support the fiscal for the household and firm. And elevated government risk can also spill over to the financial sectors. And the government risk can also spill to the financial sector, in particularly in low and middle income economies. During the 2020, the one-third of the government, which assessed by the three main rating agencies, they suffered a downgrade in their risk rating, and this deterioration can in turn require government intervention in order to capitalize the institution of the finance and uh, the trigger shock to support the government budget through the liability. And state-owned enterprise are a source of the significant liability risk for the government. So this is for my part. To the next person. Thank you.
Hello. Okay, so this part is about the global economy. So as we already know, like the pandemic have a lot of impact on our economy, and government all around the world, they're trying to come up with monetary policy and stuff in order to try to like reduce the impact on the global economy as well as their domestic economy. But it has been 2 years, and currently everyone have like getting their vaccination. So it's about time that we should start to think about what happened when the government like stop like
suspended their monetary policy, or they start to reduce the financial aid to the economy. So the massive monetary policy that we use to respond to the pandemic has been playing an important role in keeping the interest rate to remain low globally. However, as I said, we begin the process of recovering, and we are expecting all of advanced countries to withdraw their policies and measures, and we has to expect the interest rate to increase. So in this part, we're gonna be talking about the concept that we call the taper tantrum. Taper tantrum. So during the pandemic, government they buying bonds to initiate response to the pandemic, and those like method is called quantitative easing, which is a method that used by the central government or the central bank to stimulate the financial market and the economy, like by providing liquidity and keep the money flow in the economy. Central banks buying bond and mortgages to help keeping the interest rate lower and making borrowing for people and as well as for business cheaper. That mean that borrowing cheaper boost economy. Okay. But after the pandemic, the federal government or the central bank, they could start to what we call tapering off the bond that they have purchased. Like not like after like this pandemic never end, but the government, like when the government feel like okay, they buying bond like $10 billion a month, and their policy works, it helps the economy, so they're gonna start to reducing the amount of money. Like if before they buying bond like $10 million a month, now they gonna reduce to $5 million a month. So they're gonna like slowly backing out of the bond market and stuff. So what is it? Okay, bond tapering means that the government reduce the number of bond that they have purchased. Again, this reduced when they reduce the amount that they are purchasing, it's mean that they reduce the amount of money in the economy, and with less money in the economy, the value of each dollars, let's say it's a dollars, okay, it will grow, it will increase, the value will increase. It's mean that we can purchase goods and services with fewer dollars, and the inflation will slow, which sound like a pretty great news for all of us. And it sounds like they doing the right thing by tapering off bonds and stuff. But however, if we look at the history, the financial crisis in 2008, we can see that when government shows the sign, when government start to announcing they start to tapering off bonds, the global economy start to experience what we call taper tantrum. Because like as the central bank start leaving the bond market, it could lead to the drop of the bond price and push up the interest rate. And so how does it affect anything? Sorry. Interest rate, they go up and down all the time, but we need to understand that when interest rate is lower, people looking for opportunity to invest their money. So the demand for stock and bond, it increased, and with high price in bond, the bond yield will decrease. However, if the interest rates start to like increase, the bond yield will also increase. As back in like the example back in 2013, we have seen the impact of the tapering in emerging market like Brazil, India, Indonesia, South Africa, and Turkey. Now move on to the next part. The conclusion. Thank you.
Yeah, so moving on to conclusion. Next slide, please. First, we need to understand that during the process of the emerging risk to the recovery, not all governments have enough resource and capacity to sustain this program until their economy activity have fully recovered. And also, this will give a rise to the possibility that spillover effect risk among household, firm, financial, and government sector will lead to the economic fracture and pose a threat to an equitable recovery. Hence, in the emerging recovery, it's also to be found that it is high percentage to face with interconnected risk because in emerging economy country where such fragility were already more pronounced at the onset of the pandemic. And to conclude, within this chapter show that with the effectiveness of government response, that an effective policy can counteract risk to the recovery, such as well-defined fiscal, monetary, financial sector, and policy, and those can help to reduce and slow down the risk and prevent them from affecting the wider economy. And moving on to the next slide, which is presented by Sonita.
Okay, thank you. So the spotlight in this chapter, I think it's pretty interesting, especially for us as in developing countries, the financial inclusion and financial resilience. What? Oh, sorry. What is the financial inclusion? So basically, when a person have access to financial tools such as bank accounts, ABA banks and stuff, and education about finance and infrastructure, that is financial inclusion. And financial resilience is the ability of people and firms to recover from economic shocks. Basically, financial resilience is that even when we meet economic crisis, everyone still able to live like without going bankrupt. And that is financial resilience. So how is it connected, the two of them? In lower income countries, we already have a weak financial resilience. So the World Banks believe that after the pandemic, the poverty will be worse, especially in low income country, obviously. And they also believe that with financial inclusion, we could increase our financial resilience. Why? Because, you know, we are not like 2008 anymore. It's the financial crisis could be helped by digitally, because now we have digital payment, we have credit card, debit card, we have saving insurance policy that could help firm and as well as individual to manage their risk. Businesses could move online and, for example, they could send their product through delivery company and receive payment from customer online. And for individual, they could, like, if they have financial inclusion, if they have education, if they have banks account, Visa card, they could like make investment online, like cryptocurrency or NFT and stuff. So people lose income because of the pandemic, but with necessary tool in finance, they could find way to adapt and generate income from other sources. That is why we believe that financial inclusion could increase the financial resilience, especially for developing country, for low income country. Thank you. Now move on to the discussion question. Yeah.
Okay, thank you, presenter, for a very easy understand presentations. I have a few quick comment and questions before we have the discussion. So the first I'd like to ask to Davin. We talk about the corporate and government nexus, right? And you highlight the two channels, which is the direct and the indirect of the nexus between the corporate and the government. Can you explain what is the difference between direct and indirect nexus that you highlight in that part?
Could you hear me, teacher?
What's the corporate and government nexus? Okay.
So
I think it's slide number 8, right?
I think it's slide number 10.
Can you explain in slide number 8 what is the direct and indirect? Another question is that what is the definition for real sector that you talk about?
So let me go to real sector first. Real sector here refer to like the part of the economy where it produce the output. So they are the like the machine for the economy. The output they produce and they distribute to the market. So that's the definition of the sector. For the difference between the direct and indirect, like in the corporate government example, like the direct government and corporate directly involved with one another, like they depend. So when the corporate have problem, they issue like uh, some sort of package to directly have the like the corporate. So the corporate might have that some sort of fund to continue their operation, and in turn they may hire more workers to during this depressed time, and in turn when they generate profit, the government depend on that by like like tax from the corporate. So in this nexus, that's what they mean by this. And for the indirect, here, it means that like how should I say that? Just please wait a minute. Like for the indirect here, like as this we know that the government they despite like let me recap back, like the direct they directly involved with corporate, but indirect corporate need like some sort of a means to achieve their end. So government is the one who provides some sort of like the for example, let's say in the investment of infrastructure, like it indirectly affect uh, the corporate. So when there are some sort of infrastructure exists between like built by the government, so corporate benefit indirectly from the action of the government. So this nexus, that's what they mean by the indirect, teacher.
Yeah, okay, thank you for the clarifications. I have one more question for Senator regarding figure 1.7. Can you show the figure? Yes. Yes, you see the vertical axis, it's the, let's say the consolidated distance to the breakpoint. So can you explain what is the what it is intended to measure and what it mean when it have a higher value and what does it mean when it have a lower value?
Sorry, lecturer, could you repeat the question again?
Can you explain to me what is the meaning of a consolidated distance to breakpoint? So when, for example, when I get 30%, 40%, and when I have a lower value like 10%, what is the meaning and what is the intended attention of the using to measure what kind of thing?
So in the red point is in which is the low income of the people who the population in the country, like it has been affected from the pandemics. And yes, and also another two colored bar is also the which is the middle income and upper income of the population, that it has been affected to the households of the sectors of the in the family. And in general, it's also a government has a debt, like as stated in the crossbar, like in 2021 forecast, like it has the negative effects to the government, like it kept in debt from borrowing the loan from financial institution and support to the country. That's what I understand.
Okay, thank you. But I think the vertical axis are supplied by the title and the figure. It's about the banking sector fragilities. Okay, so it tell us how dangerous is the banking sector. I think it's it cover the percentage of non-performing loan. Okay, generally in bank when you have a lot of percentage of non-performing loan comparing to the total loans, it may be an indication of very risky, and it going that maybe the banking sector will have problems. Okay, so they measure to that distance. I think maybe every bank should have non-performing loan below 20%, for example, and if many of the bank actually have the more than 20%, which is threshold, then it's very risky. Okay, so large value, big value, mean more risky is the banking sector, I guess. Okay, so here they trying to say that if you likely have a very easy fragile banking sector, is all can leading to higher government debts. I think government may try to do something to resolve a problem. Okay, maybe helping the banking sector, and that would leading them to having more debts. Okay, as represented by the government gross debt. Okay, so that's what I think. So anyway, I think that's just clarification. Lastly, I want to last comment. Last question is for Sonita. It's I think it's not government, right? It's the Fed. The Fed is not the government. Okay, the Fed is the central bank in the U.S. It's not government. So it's not the government who buy the bond in quantity easing. Okay, quantity easing is this the Federal Reserve, the buy the bond and the stocks and the security. Okay, so it's not government, it's the and you mentioned it right about tempering tantrum, right? That's because at the first place, when there is a crisis, government always intended to help, so they do the quantitative easing to put more money into the economy, and then they start to withdraw. Okay, but sometimes they overspend their budget in trying to helping the economy, and they end up with very high debt. Okay, so that's as in the experience of many countries like Indonesia. So it's important to realize when should you withdraw. Okay, for example, right now the government is helping the SME in our country, right, to recover from the COVID-19. They relax the tax that SME have to pay, okay, and they provide other support, okay. But the question is that when should we, okay, when should the government withdraw this support, okay? If they withdraw so earlier, when that recipient did not recover, that could be a problem, okay. If they withdraw too late, okay, then they may having serious budget deficit because they overspend. Okay, so this is a very interesting issues. Okay, it's hard to say, okay, but it's depending on each country how fast they can recover. Okay, if they can recover sooner, then government don't have to spend a lot of budget and for financing and supporting this. I mean, the firm, the private sector, and also the household. Okay. The last part I want you to say is about the financial inclusive, which you, according to the definition, I'm not quite clear. It seems you say that financial inclusive mean the people have bank account, right? You open bank account. Is that what I mean? Just want to clarify if I'm wrong, please. Explain me again. What is mean financial inclusive?
Yes, like that. So it's not like only bank account, but all others financial tools like insurance policies and also education about finance as well.
Okay, yes, that's right. Thank you. Okay. Yes, of course, financial inclusive is not only about having bank account. It's about how the people can access to the financial services. Okay, it could be anything relating to the financial service, like being able to borrow, being able to make payments, being able to make settlements and order and other things. They can use the financial service as their benefit. That's what I mean by the financial inclusive. So sometime in our country, if we look only about, I mean, around 55%, something like that, that have bank account, adult population, okay? So more than that, I mean, more than half of the adult population don't have bank account yet. So if you define in terms of the financial inclusive, it means they may not be able to. And sometimes you can see that e-money or mobile money transfer, it's yet some people cannot know how to use it. And so still they cannot access to this kind of financial service. Anyway, I think that's the definition you give. It's okay. So let's move to your discussion questions. Can you show your discussion questions? So this is the question from our group. So you are an advisor to the government, and then you are being advised, okay, about the government debt policy. Okay, so what would be your recommendations? Okay, to reduce the government debt that happened in the since the pandemics. Okay, so how would you recommend to reduce the government debt? Okay. So would you like our presenter to clarify on the questions, or before we have discussion so we can have a smooth discussion, or it's okay? If you have, please let our presenter know so they can clarify for you before we go to discussion. Okay, so it seems like everything okay. So I like to put you into room now. Let me see, we have 23 people, so I will put you into 4 rooms. Okay. So let me put you into 4 rooms, and I will try to get our presenter to support you. Just wait a minute. So in room 1, I have Senasa there, and room 2, I have Davin, and room 3, I have Dane there, and room 5, have Kanita there. So I think we can start the room, and you have 10 minutes for the discussion. Okay, so let's start. Hello everyone, sorry to bring you back to the rooms since we almost have time. So I'd like to invite each room to share your discussions. So let me begin with room one. Room one, we have Sina, Senasat, Sonita, Tida, Morakot, and Sunho. Can you share your discussion, please?
Thank you. Good evening. I'm from representative from room one. So after the discussion, we have come up with the policy that we would like to recommend in order to manage and reduce the government debt during the pandemic. So firstly is to support on the investor, like to promote the cheap labor in short term. So this mean that to attract the foreign investor, and by this, the government should increase the working capital and decrease the labor force in short term. And secondly, to decrease some government spending or reduce the government spending, uh, like selecting some deducting some new government officer to save the government income and cut down staff or expand and reduce the focus on only the reduce the unnecessary and focus only on the important sector. And also to set out a policy and some regulation that would be help the government. Yes, that's all from our group. Thank you.
Okay, thank you, Tida, for sharing the room discussions. So let me invite room two. We have Benjamin, Vitirit, Suntai, Davin, Wari, and Samnang. Can you share your discussion, please?
For our room discussion, we think of reducing tax is a measure, but we should not increase the tax so too high, because we just recover a bit from the pandemic. And the second is it's good if our government have bond, so our government can sell bond to the financial institution or individual that have money, so we can use that money to uh, give to return back to the foreign debt. But it's still the government still owe the domestic people. It's like uh, change from owing foreigner to owing the domestic people. Yes, and it's it's the result of our discussion.
That's all, room two.
Yes, teacher.
Okay, thank you, Samnang. So I'd like to invite room three. We have Liang An, Tane, Chimeng, Dalaya, and Senha. Please.
Hello, can you hear me? Hello. Hello, can you hear me?
Yes, please continue.
Yes. From our discussion, we have come up with 3 or 4 recommendations. It is the first thing is that ICC should advise bank on reviving their loan policy, as well as restructuring loans regarding on the repayment process. For example, they can extend or give a special offer to customer or government in terms of like the repayment durations within the first year or second year. Second things that we come up with is reducing the interest rate. So customer or government can enjoy the lower interest rate, which also better off for them. And the third one, just as Article mentioned, is that the government is suggested to sell the bond. That's it for our discussion.
Okay, thank you, Dalia, from room three. So let me invite room four. We have Satyanit Panyarot, Kanata, Charlie Hing, and Chandanit, please.
Okay, so hello teacher, I'm a representative from group 4. So as our discussion, we have some recommendation for the government to reduce the debt or manage the debt more effectively. So first of all, the quantity of borrowing or the loan must remain affordable to the budget and the size of economy. This can ensure the ability of government to pay back the loan as well. And second, government should be flexible and strive for the loan that include the valuable concession or the favorable terms so that the government has the ability and more control on the loan effectively. And third, the government expense should be managed for a more prioritized sectors in order to sustain the economic performance and increase the capacity and productivity as well. And our group also agree that infrastructure is one of the important sector that can sustain the long-term growth because it's a foundation that connect with the other sector in the economy. And last but not least, we have one more suggestion that the use of debt must be conducted with the high degree or the transparency, accountability, so that the debt management of the government could be ensured in the long-term efficiency. So that's it for our group. Thank you, teacher.
Okay, thank you, Li Hing, for sharing the room discussions. Let me conclude. I think it's right that tracking foreign investment. Right, it's important. I think in this context, because they can actually draw in more capital to the key sector because as the financial, I mean, domestic finance is being affected. So the foreign finance, okay, like the foreign investment are important to complement and to replace the domestic investment. Maintaining low labor costs, I'm not quite sure, but it's hard because when you keep the minimum wage, it's only to increase the labor costs, and I don't know how to do that, but it quite sure that having low labor costs is the attractiveness to the investment. Another thing I want to say is about the managing of government expenditure. That quite true, like Lee Hing mentioned. It should, given the limited budgets, governments prioritize the key sector. And about the role of NBC, that quite sure, like Room 3 and mentioned, they should play important role because government actually are facing with us overspend. Government may overspend, so it need the role of the NBC to support, okay, in this period. About government sell being bond, when the government sell bond, indeed that they borrow, okay, they borrows. So it's will not leading to increasing in the, I mean, decreasing in the debt, but rather it's maybe increasing the debt. So when you sell bond, you want to borrow, okay. And but I'm not quite sure when switching from foreign borrower to domestic borrower. It's quite sure, like room to mention, it's you just change who you are borrow, okay, but the debt may not actually be reduced, okay, reduced. So that is the problem, okay, the problem. Anyway, I think some of the most of the idea are quite right, especially regarding the government management of the budget. It's the key, okay. So the concern is that government spend without consider the ability to earn enough revenue to pay back the loans, okay, and that is the important issues. Anyway, you mentioned a lot about all of the solution, like foreign investment, the restructuring of loan and roll NBCs, and government budget management, okay, are the key factors. I think it's a nice discussion, and also it's one of the very good discussion questions. Okay, it's quite true that government will have to face a lot of debt in this COVID-19. So I like to end the meeting here, and we will meet again next week. So enjoy the evening and have a good time with your family. And goodbye.
Thank you,
Goodbye,
teacher.
teacher.
Bye.
Goodbye.
Goodbye.